Robinhood stole from the rich and he gave that money to the poor, but now a trading platform using the same name could be putting naive investors at risk of significant financial harm. Coming up in this video, how experienced traders are taking advantage of naive, first-time, inexperienced investors on Robinhood and what you can do about it. Hi everyone, I'm Bamford, a chartered financial planner at Informed Choice, and in this video I'm taking a look at some new academic research which suggests that first-time inexperienced investors on a trading platform are at risk of significant financial harm because of their behaviour. And before I get into that study, please do take a moment to press the subscribe button down below. I make videos about personal finance, investing, economics and happiness, and I would love to have you on board as I make more of these videos in the future. But let's get into the paper, the findings of this research and what it means for you if you are a first-time or an inexperienced investor. So this is an academic paper published in October. It's called Attention-Induced Trading, Evidence from Robinhood Users. It's published by two behavioural finance experts, by Professor Brad Barber and by Terence Odeon, and they found that Robinhood has a high proportion of first-time investors and they tend to be attracted to what they call attention-grabbing stocks. And this is important because the findings of this research suggest that these first-time investors who herd together and follow, they chase the performance of these attention-grabbing stocks, they tend to lose out financially as a result. So let's take a look at what the paper said. They said that these are attention-grabbing stocks, so the stocks that we tend to see in the news, the stocks that tend to make the headlines when their prices surge and go up rapidly, but also stocks which are widely discussed on investing forums and on social media. And the problem with these attention-grabbing stocks is that first-time investors like to herd together and follow the same stocks at the same time. So they buy stocks which are rapidly rising in price because they're being well covered in the media, on platforms and forums, on social media. And then what seems to be happening is that short sellers who bet against a particular company and profit from when its stock price falls, they spot this herding behavior. They see these first-time buyers, these first-time investors chasing a particular stock, and they target those stocks for their short selling activity. And according to this research, the top stocks traded on the Robinhood platform tend to fall by an average of 5% in the following month. And the really popular ones, which experience an extreme herding pattern, tend to fall by an average of 9% in the following month after that herding activity. But this research is suggesting that there is a strong correlation between hyped up stocks and this herding activity, and then a subsequent, quite short-term loss of money. So let's take a closer look at some of the findings in this research. It's fascinating stuff. They looked at the trading activity on Robinhood between the 2nd of May 2018 and the 13th of August 2020. So a significant chunk of that study was during the pandemic, when there has been a big rise in the popularity of these trading platforms, including Robinhood. Lots of people sitting at home, becoming day traders for the first time, maybe having a bit of spare cash because they're no longer spending it on eating out or going on holiday or commuting, so putting that cash to use and becoming investors and traders for the first time. And the researchers looked at herding events, so we looked at these most popular stocks being traded on the platform. They concluded that the top 0.5% of stocks being traded in a given day would typically fall in price over the next month by approximately 5%. And then the really popular ones, where this extreme herding activity was taking place, would fall in value in the following month by approximately 9%. So some significant stock price falls following these herding events. And in conclusion, the researchers said large increases in Robinhood users are often accompanied by large price spikes and are followed by reliably negative returns. So when this herding activity takes place, when we see herding which drives up the price of a particular stock, why then does the price of the stock fall in value? So when we see these herding events, what is causing the stock price to go up? What's causing the herding to take place in the first place? And why do we then see a subsequent fall in the stock price? One factor does appear to be the level of inexperience of some of these investors on the Robinhood platform and on other trading platforms. They seem to be buying stocks not based on any fundamental measurement of that stock, but because the price is going up and they want to climb on and enjoy that ride, hopefully to the top. So this is a very bad idea. It's a bad idea to buy a stock simply because it's going up, and it creates something of a feedback loop. The stock price keeps on rising for the short term because more people are investing, seeing the price go up, so more people invest. And that feedback loop is one of the symptoms of a price bubble in the world of investing. So it can very quickly, as we're seeing with this research, cause a reversal in the price of the stock. And the app itself, this Robinhood app, appears, according to the researchers, to be exacerbating the problem, and that's because it highlights these top performing stocks in the very short term and catches more attention from these inexperienced investors who then pile in with more of their own money. So the app design itself is causing a problem. It's causing more of this feedback loop. The research also suggests that the setup of this particular trading platform could be causing more problems because firstly it's very easy to use, and secondly it's cheap, it's commission free, and as a result the turnover of stocks held on the portfolios in Robinhood seem to be multiples higher than the turnover experienced on other trading platforms because, put simply, it's too easy to use and there's little barrier to selling or buying stocks on there. If you make a trading platform too cheap and easy to use, then inexperienced investors are likely to buy and sell more often. Their turnover rate's going to go up. And that's the precise opposite of what experienced investors do. Experienced investors tend to buy and hold stocks rather than trade them in the short term. And I'll come on in a second to explain why that short-term trading is such a terrible idea. There are, of course, good reasons to buy and sell stocks, to buy and sell investments. If you are planning to invest for your retirement, so you're buying stocks to fund your retirement. If you have liquidity concerns and you need to sell stocks to raise money to deal with those liquidity issues. For tax harvesting and also for asset allocation and rebalancing, just to maintain the overall risk profile, risk level of your portfolio. Those are valid reasons for buying and selling stocks, but chasing performance, I'm sorry to say, is not a good reason to buy and sell stocks. With all that in mind, what is causing these price losses in the month or so following the price spikes? And as the researchers say, this is reliably negative performance when there's herding behaviour. They can predict quite reliably now that the price of the stock is going to go down in value. In part, this is simply a result of reversion to mean. So once the herding behaviour loses some steam, the stock price simply returns back to its fundamental levels, a level at which that price is supported. But the other, perhaps more sinister factor at play here is that the academics believe that experienced traders are keeping a close eye on these herding patterns. So they're seeing which stocks are all of a sudden attracting popularity, attracting lots of new inexperienced investors, and they are targeting those by shorting that stock, expecting it to go down in price, and by shorting it, actually helping it to go down in price. They're squeezing these inexperienced investors. They are juicing their money out of them, and that's perhaps the more sinister aspect of this research. Now, Robinhood were given a right to reply when this research was published. They did not respond to that, but they did speak to another news agency in the US, and they said that the vast majority of the investors on this platform are not day traders, but they are buy and hold investors for the long term. So they apparently said that 98% of their users are not pattern day traders. So a response there suggesting that actually this is not because Robinhood users are trying to be day traders, but they are long-term investors. It's really important to note here that day traders do not make money. The vast majority of day traders lose an awful lot of money, and it is not a good idea to become a day trader. There was an academic study in Brazil back in June, and that study found that only 3% of day traders they looked at 1,600 day traders in Brazil, but only 3% made money over the course of a year. And of those, 1.1% made more than the Brazilian minimum wage, and only 0.5% made more than the starting salary of a banking clerk. So the conclusion from that academic study, and we have seen this time and time again with studies into the success or otherwise of day traders, is that the vast majority lose money. But day trading seems to remain a popular pastime. We see so many social media posts and promotions about the apparent success of traders posing with their Lamborghinis and supercars. But in the main, they are there to sell you courses, they are there to sell you trading signals, which are in no way guaranteed to make you any money. In fact, all the research suggests the otherwise. It will lose you money. There is a world of difference between investing and trading or speculation. Investing can make you money, but it takes a long time. This is not something that can be measured in terms of success in days, months, or even years. It is a multi-decade activity. Now, I appreciate the lure of apps like Robinhood and trading platforms which offer this cheap and easy access to buy and trade stocks, particularly when that's backed up by social media posts. But you are not going to make money from being a day trader. You're not going to end up with a Lambo. I promise you that. What you're more likely to do, far more likely to do, is lose a significant amount of the money you invest or try and trade with. It is by no means a viable alternative to a day job. I'm sorry to say, do not quit your job and try and become a trader because of something you've seen on Instagram. It's not going to work. As a first-time investor, I absolutely appreciate the attraction of a trading platform like Robinhood, but I don't believe that first-time investors who start trading stocks are well equipped for that particular battle. In fact, they may not even realise there's a battle going on at all. But what seems to be happening, and this is backed up and identified by this academic research, is that first-time investors are trading and they are herding together, and then experienced traders are taking advantage of them. They are squeezing these first-time inexperienced investors and they are juicing their profits out of them. So it is a bad idea to follow the herd on Robinhood or other trading platforms and buy stocks simply because they are popular and they are well covered in the media, on forums, on social media. So instead, as an investor, you need to take the long view. You need to invest broadly across different asset classes, different sectors. This is diversification. This is about not keeping all of your eggs in one basket. And you need to stop chasing performance. You need to buy investments because of fundamental reasons, not because they are today's hot stocks. You're not going to end up with a Lambo. You are going to end up poorer if you follow that strategy. I hope you found this video useful. Thank you so much for watching. Do press that subscribe button. Do hit like, do comment and share any thoughts you have about this research. I'll put a link to the paper and its synopsis in the description below. Until next time, I'm Martin Bamford, and when it comes to your money, the more you know, the faster it can grow.